Ladies and gentlemen, we have seen mind-boggling rallies in equity markets around the world over the last 1 year. Here in India, the benchmark NIFTY-50 index has rallied a spectacular 30% since March of 2023. So what is it that's driving these spectacular rallies in equity markets around the world? Well, in our opinion, one of the most important sources of liquidity that has been driving these mind-boggling equity market rallies is this account maintained by the Federal Reserve Bank in the US called the Reverse Repo Facility, or the RRP in short. The balance in the RRP hit an all-time high of almost $2.4 trillion, trillion with a T, in April of 2023. And since then, we have had almost $1.9 trillion flow out of the RRP into global asset markets. And these gigantic outflows have provided liquidity support to almost every asset market in the world over the last 1 year. And these outflows have also helped almost every equity market around the world scale new all-time highs over the last 1 year. But there's also something to be concerned about the RRP, ladies and gentlemen. As we speak, the balance left in the RRP is now down to just $460 billion. From a peak of almost $2.4 trillion, we are down to $460 billion. And at the rate at which the RRP is being depleted, even this remaining $460 billion could be gone in the next couple of months. And once that happens, ladies and gentlemen, that could pose a very serious challenge to the continuation of these rallies that we are witnessing in equity markets around the world. Hi, my name is Indranil Guha and I'm one of the co-founders of Metacaps.ai, which is an AI-driven personal finance platform. Ladies and gentlemen, there's been a dramatic improvement in liquidity conditions around the world over the last 1 year, and this in turn has helped drive spectacular rallies in equity markets around the world. So much so that most equity markets around the world have scaled new all-time highs over the last 1 year. But there's a difference, ladies and gentlemen, this time. The source of liquidity that has been driving these spectacular rallies in equity markets around the world has been different this time compared to the source of liquidity in case of previous liquidity-driven rallies. You might ask, how does the source matter? It does matter, ladies and gentlemen, because only if we are able to identify the source of liquidity correctly will we be able to objectively assess as to how long this source of liquidity is going to last, which in turn is going to determine how long these liquidity-driven rallies are likely to sustain. Ladies and gentlemen, historically, liquidity-driven rallies have been triggered in the past as a result of global central banks, especially the Federal Reserve in the US, printing a lot of money and flooding asset markets with a lot of liquidity. But that's not been the case this time around, because over the last 1 year, most global central banks, especially the Federal Reserve in the US, have in fact been cutting liquidity rather than improve liquidity. The Federal Reserve in particular has been conducting what is called QT, Quantitative Tightening, as part of which it has been explicitly cutting liquidity rather than add to the liquidity of asset markets. And yet equity markets around the world have rallied as spectacularly as they have over the last 1 year, because they have received liquidity support from another source, and this another source is called the Reverse Repo Facility, or the RRP in short. Ladies and gentlemen, I had done a dedicated video on RRP about 2 weeks back, where I had discussed the dynamics of how the RRP has helped provide liquidity support to asset markets around the world over the last 1 year. If you have not seen that video, I would strongly urge you to have a look at that video. I'm going to leave a link to that video in the description section. And yet I'm having to revisit the RRP within a matter of just 2 weeks, because the balance left in the RRP is now precariously low, and that has grave implications for how long this liquidity-driven rally can sustain itself. But let's first look at how liquidity-driven rallies have historically played out in the past. What you see on your screen right now is a chart that depicts the size of the Fed's balance sheet size. Well, I know that sounds like a lot of mumbo jumbo, but don't worry, I'm going to break it up for you. Firstly, what is the Fed? Fed stands for the Federal Reserve Bank. The Fed is the central bank of the US. Like here in India, we have the Reserve Bank of India, the RBI, which acts as our central bank. In the US, they have the Federal Reserve Bank, or the Fed in short, which acts as their central bank. One of the primary functions of the Fed is to decide the amount of new US dollars that must be printed into existence. And if I have to describe this in very layman's terms, this chart basically depicts the amount of new US dollars that the Fed has printed into existence over the last 15 years. What we also can see in this chart is that over the last 15 years, there have been two distinct periods when there has been a very large spurt in the rate of money printing done by the Fed. The first time this happened was after 2008, and the second time this happened was after 2020. Whenever you have Fed conducting money printing at this accelerated pace, this process is usually referred to as quantitative easing, QE. QE is just a jargon which refers to the phenomena of Fed conducting money printing at an accelerated rate. Why did the Fed have to conduct QE after 2008 and after 2020? Because the US economy witnessed one of the worst recessions in recorded history in 2008. And in response to that, the Fed had to step in and print a lot of money, because when the Fed prints money, that helps provide liquidity support both to the real economy as well as to financial markets. The same thing happened in 2020 once again, when we had the onset of the COVID pandemic, and as a result, the US economy witnessed a very severe recession once again. And in response to that, the Fed had to once again conduct QE and print lots of money. What was the amount of money that was printed during the course of these two QEs? For the first time when the Fed conducted QE, this QE lasted for almost 6 years, between late 2008 and early 2015. Over this 6-year period, the size of the Fed's balance sheet size went up from about 1 trillion to almost 4.5 trillion. So basically, during this period, the Fed ended up printing about $3.5 trillion. What happened during the second time when the Fed conducted QE after COVID? This was a very concentrated QE. This time around, the Fed conducted QE for a period of only 2 years, starting March of 2020. But during this 2-year period, the Fed's balance sheet size went up from almost $4 trillion to $9 trillion. So basically, the Fed ended up printing almost $5 trillion during this period. And what is the impact of all this money printing on equity markets? Well, let me be upfront. The impact of money printing on equity markets has invariably been very, very positive, because whenever the Fed prints money, invariably some of these newly created dollars find their way back into equity markets, and that helps trigger strong rallies in equity markets. And these rallies are typically not limited only to the US markets. You see these rallies happen almost across every leading equity market around the world, especially in emerging market equity markets. Why so? This is because of the special nature of the US dollar. US dollar is the reserve currency of the world. Whenever you have money printing going on in US, foreign institutional investors, FIIs, take some of these newly created dollars to emerging markets like India, and when you have an influx of these dollars into emerging markets, into the equity markets of emerging markets, you have strong rallies being triggered in these markets as well. And as a result, historically it has been seen that whenever the Fed conducts QE in the US, the impact of that has been very, very positive, not just within the US equity markets, but pretty much across every equity market around the world, especially in equity markets of emerging markets like India. And we can clearly see that if we overlay the chart of the Nifty on top of this chart of the Fed's balance sheet size. As you can see, I have added this blue line. This blue line is the chart of the Nifty, and we can very clearly see in this chart that on both the occasions in the past, after 2008 as well as after 2020, when the Fed conducted QE, on both these occasions, as the red line, the amount of money that the Fed printed went up, we had the blue line also go up as strongly. So the red line and the blue line went up in tandem. So this relationship seems to be very, very pakka. Whenever you have money printing going on in US, that helps trigger very strong rallies, not just in the US, but also in emerging markets like India. But ladies and gentlemen, we are right now in 2024. This is not the time when the Fed is printing money. This is not the time when the Fed is adding to the liquidity of the financial system. In fact, we are right now going through a period that is referred to as QT, quantitative tightening. This is the time when the Fed is in fact cutting liquidity. So we have had two occasions in history when the Fed has had to conduct QT. The first time the Fed conducted QT was between 2017 and 2019. This is a period, as you can see, this is the time when the red line, the Fed's balance sheet size, started to go down. The red line starting to go down basically signifies that the Fed is cutting liquidity. And ladies and gentlemen, if Fed printing money and adding to the liquidity of the financial system was positive, had a positive impact on equity markets, by corollary, Fed cutting liquidity can never be a good thing for equity markets. And we can clearly see that if we do a deep dive into the period from between 2017 and 2019. This is the same chart, but I am basically taking a close-up view of what was happening in the markets between 2017 and 2019, the period when the Fed was conducting QT. As you can see, from October 2017 onwards, the Fed started conducting QT, and this QT went on till September of 2019. And during this time, the Nifty became very, very volatile. The Nifty tried to make new highs 3 times, but it could not sustain any of these 3 highs. Every time it would make a new high, and after that a correction would kick in and it would give up all its gains. So the Nifty became very, very volatile, and this was the same story across every leading equity market around the world. So this is the impact that QT, quantitative tightening, has on equity markets. So this was the story of the first QT. What's been happening during the course of the second QT? As you can see, the Fed started conducting QT for the second time in its history from June of 2022 onwards. From after June of 2022, this red line started to come down. So the Fed has been cutting liquidity, and this second QT is on as we speak. But ladies and gentlemen, despite the fact that the Fed has been conducting QT and has been cutting liquidity, equity markets around the world have been on a complete tear. Here in India, the NIFTY-50 index has in fact rallied by a spectacular 30% since March of 2023. So there is a complete disconnect between what the Fed has been doing with respect to liquidity and how equity markets are reacting. So what is the reason why there is such a big divergence between the liquidity posture of the Fed and the reaction of equity markets? So the reason why the Nifty and almost every other equity market around the world has been on an one-way street up since last year, despite the Fed in fact cutting liquidity as part of its QT exercise, is this entity called the reverse repo facility, or the RRP. But before I explain to you what exactly is the RRP, I need to first take you back to this chart that I showed you towards the beginning of this video. This chart depicts how the Fed had to print a lot of money at the onset of the COVID pandemic in order to provide liquidity support to the US economy as well as financial markets. As you can see in this chart, since the onset of the COVID pandemic, the Fed printed a humongous amount of money. The Fed printed almost $5 trillion. So what happened to all this money? So all this money first went to the US government. And what did the US government do with this money? US government used a good part of this money to provide financial support to US citizens who were directly impacted as a result of the COVID pandemic, especially those who had lost their jobs as a result of the COVID pandemic. Such people received large amount of cash handouts from the US government in the form of direct cash transfers into their bank accounts. So when you have a large number of beneficiaries receiving financial support from the US government, the amount of cash in the banking system at an aggregate level goes up quite significantly. And that's exactly what happened in the aftermath of the COVID pandemic. And as a result, the amount of cash in the banking system went up very, very dramatically. Now think about it, when the amount of cash in the banking system goes up very dramatically, what is the kind of impact that is likely to have on the interest rate offered by banks to depositors? Interest rate offered by banks to depositors under such circumstances would start to go down quite dramatically. Why so? Because think about it this way, why do banks have to offer an interest rate to depositors at the first place? Banks have to offer an interest rate to depositors in order to attract deposits. But if you are in a situation where there is already a deluge of deposits coming into the banking system, then banks do not have to offer any interest rate, a high interest rate to depositors in order to attract deposits. In fact, during the COVID pandemic, the rate of inflows of deposits was so high into the banking system that the interest rate that most banks were paying to their depositors very, very quickly collapsed to practically zero. In fact, there was a very real risk at one point that if the rate of deposit coming into the banking system continues to rise at the rate at which it was, then interest rate in the US banking system could well turn negative. And that was something that the Fed was absolutely clear that it wouldn't allow at any cost. Because if interest rate in the banking system turns negative, that leads to a whole bunch of other complications related to a phenomena called deflation. This is something that has already happened in Europe, this is something that has happened in Japan, and this is something that the Fed was absolutely clear it wouldn't allow a recurrence in the United States. And how did the Fed ensure that you don't get negative interest rate in the banking system of the United States? Fed basically revived this account, this facility called the reverse repo facility in 2021. So what the Fed started to do was to offer a slightly higher positive interest rate on to anyone who would keep their money in the reverse repo facility compared to the interest rate that was being offered by banks at that point in time. At that point in time, the banks were offering practically zero interest rate. The Fed started offering a small positive interest rate of 0.15% per annum at that point in time. Now you might say that 0.15% interest rate is absolutely negligible, shouldn't make any difference, right? But think about this way, this was being offered at a time when, what was the alternative? The alternative was the interest rate that banks were offering to you on your deposits, and that interest rate was practically zero. So something was better than nothing. And this also helped ensure that banks could not take the interest rate that they would offer on their deposits to negative territory. Because if the banks started charging a negative interest rates, then depositors had the option to withdraw all their deposits and move all their money to the reverse repo facility and enjoy this small positive interest rate that the Fed was offering on the RRP facility. Now, to be sure, retail depositors could not directly access the reverse repo facility, but there are what are called money market funds, or as we call it in India, debt funds, through which retail depositors could access the reverse repo facility and enjoy the interest rate that was offered by the Fed on the reverse repo facility. Now this 0.15% interest rate, this negligible rate of interest, was something that the Fed was offering back in 2021 when the overall rate of interest in the US economy was very low. But since then, inflation started to go up very dramatically in the US, and as inflation started to go up, the Fed also started to hike rates. And as Fed started to hike rates, the interest rate that the Fed started to offer on the reverse repo facility also started to go up. And over time, as we speak right now, the Fed is offering an interest rate of 5.3% per annum on anyone who keeps their money with the reverse repo facility. So what started off as just 0.15% per annum has now gone up to 5.3% per annum. 5.3% per annum is a very, very high interest rate by US standards. And as the rate of interest that the Fed started to offer on the reverse repo facility started to go up, so did the quantum of inflows coming into the reverse repo facility. And this chart shows how deposits have steadily ramped up in the reverse repo facility since 2021. As you can see, in early 2021, the amount of deposits in the RRP facility was practically zero. But over time, as the interest rate offered by the Fed on the RRP facility started to go up, record amount of inflows started to come into the RRP facility, and the balance in the RRP facility hit an all-time high of almost $2.4 trillion, trillion with a T, by April of 2023. Within a 2-year period, from zero it went to $2.4 trillion. So that's a humongous amount of inflow, as you can see, that happened into the RRP facility. In the process, so this is a very smart thing that the Fed was able to do. Fed was able to create this pool of liquidity in the form of the RRP facility for the US financial system, and this liquidity pool could now provide liquidity support to rest of the US financial system at a time when the Fed itself could not directly intervene and provide liquidity, because the Fed itself has been conducting QT since middle of 2022. And as you can see, what has happened since then is that out of this $2.4 trillion war chest that the Fed was able to build by 2023, we have had almost $1.9 trillion flow out of the RRP into global asset markets, and these gigantic outflows are what has helped provide liquidity support to almost every asset market in the world over the last 1 year. And the primary beneficiary of these outflows have especially been equity markets around the world. Because of the liquidity support that equity markets have received as a result of these outflows, almost every equity market in the world has managed to scale new all-time highs as a result of the improved liquidity conditions that has been witnessed around the world. If we have to look at this in terms of hard numbers, what has been happening over the last 1 year is that the Fed has in fact been cutting liquidity. As I mentioned, the Fed has been conducting QT at a rate of $95 billion per month. So this is the amount of liquidity being cut by the Fed. But against this, the monthly rate of outflows from the RRP has been almost $200 billion. So against $95 billion of liquidity reduction, we have $200 billion of liquidity addition coming into the financial system. So the net liquidity addition has been about 200 minus 95, almost $105 billion per month. That's been the rate of net liquidity addition. And because of this net liquidity positive condition, we have had this dramatic improvement in liquidity conditions in almost every asset market in the world. And because of that, especially the equity markets have benefited very, very remarkably. But ladies and gentlemen, this party cannot go on forever. As you can see, the balance left in the RRP is now down to just $460 billion. From a peak of almost $2.4 trillion last year, we are now down to just $460 billion. So more than 80% of the RRP balance is now gone. And what is even more alarming is the rate at which the RRP continues to be drained. Just about 2 weeks back, when I recorded my last video on the RRP, the balance available in the RRP at that stage was about $550 billion. And in just the 2 weeks since then, the balance is now down to $460 billion. So $90 billion gone in just the last 2 weeks. Ladies and gentlemen, if the RRP continues to be drained at this rate of $90 billion every 2 weeks, then even this remaining $460 billion is going to be gone in just about 2 weeks, in just about 10 weeks. That's about 2.5 months. Ladies and gentlemen, once that happens, there will be no liquidity pool left in the US financial system that would be able to offset the impact of the Fed cutting liquidity as part of its quantitative tightening process, and that would well lead to the emergence of a situation of extreme liquidity crunch, and that would almost certainly pose a very, very serious challenge to the continuation of the rally that we have been witnessing in equity markets around the world since early 2023. Ladies and gentlemen, I'll also use this opportunity to address a few recurring queries that I have been receiving since the last video that I posted on the RRP about 2 weeks back. One of the recurring questions that I have been receiving is that where exactly have these huge outflows from the RRP going towards? Have they been going from the RRP to directly into the equity markets, and in the process these outflows have helped improve the liquidity of equity markets? Ladies and gentlemen, the short answer is no. Most of these outflows from the RRP have not gone directly from the RRP into the equity markets. In fact, most of these outflows have gone to the bond market. What has actually been happening, especially since June of 2023, is that the US government has been borrowing at a very, very accelerated pace by issuing a large amount of US government bonds. And in the process of selling these US government bonds, the US government has been trying to specifically target this huge cash pile that was available in the RRP. And it was trying to target this cash pile in the RRP by offering a slightly higher interest rate than what the Fed has been offering on the RRP balance. So the Fed, as I mentioned to you, has been offering an interest rate of about 5.3% per annum on the RRP balances. The US government on its part has been, on all its new government bond issuances since middle of last year, has started offering an interest rate of about 5.4 to 5.5% on all these new government bonds, and in the process it has been able to attract a lot of this cash that was so far sitting in the RRP. A lot of this cash that was sitting in the RRP, because of the slightly higher interest rate, flowed out of the RRP into the US government bonds. Now this gives rise to the next question. If most of the outflows have gone from RRP into the bond market, then how is it that I can claim that the RRP has helped improve the liquidity of equity markets? And that's a very, very important question. Ladies and gentlemen, imagine two scenarios. Scenario A is where investors in the market cumulatively have about $1 trillion available with them to invest in stocks and bonds of their choice. So that's the amount of liquidity available with investors. On top of this, there is also about $2.4 trillion sitting in the RRP. Now imagine another scenario, scenario B, where investors have the same amount of liquidity available with them, $1 trillion, but in this scenario, there is no RRP. Now imagine what will happen in these two scenarios when the US government comes into the bond market to sell US government bonds worth, let's say, $800 billion. One thing that you have to understand with respect to US government bonds is that US government bonds are almost universally considered to be the world's most risk-free investment. Because anyone who lends to the US government by investing in US government bonds, nobody really expects US government to ever default on its repayment obligations. Everyone who lends to the US government is absolutely certain that they will be able to get back the money that they have invested along with the interest. And because of this risk-free perception about the US government bonds almost always command literally unlimited demand in any market scenario. So you will never really have a situation where the US government comes into the bond market to sell their bonds and they are not able to find enough investors to sell their bonds to. But it doesn't mean that when the US government comes to the bond market to sell their bond, it doesn't have any impact on the overall liquidity of the market. Now let's go back to the two scenarios that we talked about. In scenario A, where we have the RRP, in this scenario, if the US government comes to sell bonds worth $800 billion, it will be able to very easily get this $800 billion by targeting the balance sitting in the RRP. All it has to do is to offer a slightly higher interest rate than what the Fed is offering on the RRP balance, and that's how it will be able to get the $800 billion it wants from the RRP. And the $1 trillion worth of liquidity that is available with investors, that will remain intact and investors would be free to invest in any other asset class that they want to, including equity markets. Now imagine scenario B. In this scenario, there is no RRP. In this scenario, if the US government comes to sell bonds worth $800 billion, they will be able to sell their bonds worth $800 billion. But in this scenario, this $800 billion will come from the liquidity that is available with investors, the $1 trillion worth of liquidity that is available with investors. So after US government has been able to sell all the bonds that they want to, investors would be left with a liquidity of only $200 billion. So this is the liquidity that is now available for investments in other asset classes, including equity markets. So now do you see the difference between the two scenarios? There is a humongous difference in the amount of liquidity that is available for investments in, let's say, equity markets in scenario A and scenario B. And that difference is because of the RRP. So what the RRP basically helps in is it frees up the liquidity that is available with investors to invest in any asset of their choice, including in equity markets. And this is precisely what has been happening over the last 1 year. Because of the RRP, the entire liquidity that has been available with investors, they have been able to direct this entire liquidity towards equity markets, and that's how the presence of the RRP has been able to help improve the liquidity of equity markets. However, I must admit that this liquidity support has been somewhat indirect, but nonetheless, this has been a very, very important source of liquidity for equity markets. Had it not been for the RRP, the amount of liquidity that went into the equity markets would not have been as high, and that definitely would have had impact on the quantum of the rally that we have seen in the last 1 year. The last question I want to address as part of this video, ladies and gentlemen, is what are the possible outcomes once the RRP balance goes to zero? So are we likely to see a large market correction as and when the RRP balance goes to zero? Not necessarily so. There's a whole bunch of outcomes that is possible once the RRP balance goes to zero. It's entirely possible that the Fed could take proactive cognizance of the fact that RRP balance is being depleted, and in order to offset the impact of that, the Fed could proactively start slowing down the rate of QT or could even wind down QT altogether. And if that were to happen, that would almost certainly have a very, very positive outcome for the overall liquidity condition and for the equity markets. Because if there is no QT, then you don't need the RRP. Because if there is no QT, then you don't need anything to offset the impact of the Fed cutting liquidity as part of the QT process. So if the Fed proactively slows down QT or ends QT altogether, that would almost certainly have a very, very positive outcome for equity markets. So that is the first outcome that is possible. At the same time, it is entirely possible that the Fed does nothing. It lets the RRP balance go to zero, and yet at the same time it lets the QT run at the current rate of about $95 billion per month. And if that were to happen, then we would almost certainly end up in a situation where liquidity situations would become very, very tight, and that could lead to dislocations in some or the other part of the financial system. Ultimately, something or the other could break somewhere in the financial system. And when I say something could break in the financial system, it doesn't necessarily have to be in the form of a large correction in the equity market. You have other parts of the financial system where we could see stress. So for example, we had a similar situation back in September of 2019 when the US repo market blew up on the night of 17 September 2019 because of the extremely tight liquidity conditions that emerged on that night. We had the overnight repo rate in the US repo market shoot up to 10%. So this is how things can start to break apart. And if some distress starts to build in this manner, we have some dislocation in the repo market, or we have a large correction in the equity market itself, at that stage the Fed might not have any option left but to step in and intervene in the market. And the intervention could well be first in the form of winding down the QT, and depending on the severity of the condition, the Fed could well have to even go back to money printing, could well have to start doing QE as it had to do back in September of 2019. And if this is the sequence of events that follows, then we could have a situation that initially equity markets could witness a downjump because of because of liquidity conditions tightening, and eventually once the Fed steps in to rescue the system, post that we could see a rebound rally in the equity markets kick in. So as you can see, ladies and gentlemen, there is a whole bunch of outcomes that is possible. If you ask me which of the two outcomes is more likely, it's very difficult to hazard a guess, but if I must make an informed guess, I would tilt towards the latter, because the Fed's track record suggests that Fed has never really acted proactively. More often than not, the Fed reacts to an emerging situation only after something breaks somewhere in the financial system does the Fed step in with some kind of an intervention, and hence there's a higher likelihood in my view that the Fed would take action only after something breaks in the system. So once again, ladies and gentlemen, with respect to the various outcomes that is possible at this stage, the primary intention of this video is not to speculate on the possible outcomes, but the primary intention is to equip you with a framework, is to educate you, provide you with this indicator called the RRP, based on which you can yourself proactively monitor the liquidity condition of the US financial system and accordingly take appropriate action with your equity portfolio in the light of the emerging liquidity conditions. Ladies and gentlemen, this brings me to the end of this video. I hope you liked the content that I presented during the course of this video. If you did, please do like and share this video, and please do consider subscribing to my channel. Thank you very much.